Okay, so let's go back to the PowerPoint. So that was dealing with short-term notes payable. Now let's talk about what we call a discounted note. So as a note issuer, we have two options. We can either issue the note like we just did, you know, where we had a face amount and an accrued interest, an interest-bearing note, or we can issue what we call a discounted note. Okay? A discounted note is when basically what we do is the interest rate is calculated the same way, but we call it a discount rate. And what happens is, instead of receiving the full amount, you know, the face value, we go ahead and take that interest or discount off the top of it. So what we do is we take our face value, we still calculate the interest the same way, although we call it a discount now. And then we're going to take the face value minus that discount, and that's going to be the proceeds, or the amount that we're going to receive on the note. Okay? So it's going to be just a little different. The debtor is still going to pay back the face value. So really it's all equal in the end, you know, they're still getting interest. It's just the person that's the creditor that's actually lending us money is getting, you know, they're issuing less money up front. So we're actually getting, you know, you're going to go ahead and take off. So from the debtor side, the borrower, it's like we're paying the interest up front almost. Okay, that's kind of how I look at it. So the debtor, the borrower, is going to receive the face amount minus that discount. And again, the discount's calculated the same way we would calculate the interest. And then when we pay it back, we're paying back the full face amount. Okay. So it's just a little different way of looking at it. So for example, on August 10th, Carey Company issues a $20,000 90-day discounted note to Western National Bank. The discount rate is 15%, and the amount of the discount is $750. So again, we're just changing terminology here. We're calling it a discount instead of an interest rate, but it's the same calculation. Face value times interest times time. So to record the entry of that note issuance, so notice it changes. So now we're recognizing that interest expense up front. So we're the borrower. We got cash. The cash amount we got was the face value of $20,000 minus that discount of $750. Okay. So we're taking the interest up front. We're taking it off up front. We're paying the interest up front. So we're getting cash of $19,250. We're recognizing interest expense of $750. Okay. But then when the note matures in 90 days, we're going to pay them the $20,000. Okay. So they're still getting the interest on this. You know, it's just a different way of looking at it. So we're giving, from the creditor standpoint, we're giving the borrower less money up front. And the borrower is recognizing the interest expense up front. And then when they pay it back, they're paying the face value. So from the borrower standpoint, you know, we're receiving less money up front, and we're still paying the interest.
No, we don't got to pay interest already, or?
Yeah, we just don't have to recognize the interest when we pay it. So when we pay it, we just pay the $20,000.
Gotcha.
Yeah. So it's just a little different way of doing it. And sometimes this is better more for the creditor, you know, because they're basically, you know, they're giving us less up front, so they're holding on to money longer.
This is assuming they pay it on time, though.
Correct. Yeah. We will assume that they'll pay on time. And cross our fingers, right? Yeah. But yeah, under the assumption that they pay us back on time, it is better for the creditor because we're giving them less cash up front. But from the borrower's standpoint, we're receiving less cash. It's really not as attractive to us. But, you know, we're recognizing the interest up front. So then when we pay it, it's an easier entry because we don't have to recognize any interest. We've already recognized the interest. So we truly just debit notes payable and credit cash for the face amount. Okay. So it's just a little different approach. And Again, it can be more attractive more from the creditor standpoint with this than from the borrower standpoint. Any questions on that? Okay, well, while we're in here, why don't we go ahead then and go back to the practice and do an example on a discounted note. So go back and disengage to your practice. And our second one is entry for discounted notes payable. So we have a business issued a 60-day note for $75,000 to a creditor on account. The note was discounted at 7%. Assume a 360-day year. So again, we're calling it a discount instead of an interest rate, but you're calculating that discount, that interest expense the same exact way, okay? It's just our journal entries are different. So we have a $75,000 note, and it's what, 7%, and it's 60 days over 360. So what is the discount amount on that note?
875.
875, very good. So the discount is 875. Again, that discount is still charged to interest expense. We're just recognizing it up front. Okay. So in this case, how much cash did we actually receive? Was cash, wasn't it? Or I'm sorry, not cash, but how much on our accounts payable is being issued? What's the proceeds? Sorry.
75,000 minus that.
Yeah, very good. To calculate the proceeds of the note, we take the 75,000 minus the 875 discount.
So why is it not how's it accounts paid?
In this case, they told us a business issued a 60-day note to a creditor on account. Yeah. I didn't read it very well the first time either, did I? I was like going to say cash. So yeah, when it's on account, that means we're settling an accounts payable. So the proceeds are $74,125. Okay, that's what we call the proceeds of the note. That's going to be a debit to accounts payable. So accounts payable gets debited $74,125. Again, we're recognizing this interest when the note gets issued with a discounted note. So interest expense gets recognized for $875. And then the note payable, the face value is still the $75,000. Okay. So a discounted note, we recognize the interest up front. So we have to calculate the proceeds of the note. So the principal amount minus the interest. But then when it matures, it makes for a very easy journal entry because we just pay back the face value. So we debit notes payable and credit cash for the $75,000. For $75,000. Any questions on that one? So we didn't deal with that on the notes receivable side. So that's like the newer concept when we're dealing with notes, is that we can issue a discounted note. Again, the benefit here to the creditor is since we're giving them more or less money up front, we're holding on to more funds. You know, we're basically getting our interest payment up front. You can kind of look at it like that, or we're saving that. So then we could, you know, keep that money, earn interest on it. The benefit from the borrower side, I guess you could look at it as, well, we're recognizing the interest expense up front, so we don't have to worry about it later. But it's really more of a benefit to the creditor.